Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's going on in investment markets and what to look out for in the weeks ahead. Now, there are three things that have really happened in the last week, and they are Brexit, they are bond markets, and they are stock markets, with a little bit of the trade war thrown in for good measure. Now, what a difference a week does make. You wouldn't really want to be a trader, a day trader in this environment, because things are moving very quickly. Things are very volatile, and trends that have been quite well established of late are suddenly turning on their head, and vice versa. So as long-term investors, this isn't as much of a problem because we can try and ride out these periods of volatility. But if we go and look at the UK, so look at Boris Johnson, what's going on there. Now, the pound has had a massive impact on our portfolio. So you will have felt your portfolio or seen it go up and down in line with what's going on with Brexit. Now, if you look at the US dollar versus the pound exchange rate, we fell below $1.20 about a week or so ago when a hard no-deal Brexit looked the most likely outcome. Then we started to rally. We got up to about 121, 122. Well, this week we actually got up towards $1.24. Now, that was because the UK Parliament started to frustrate Boris Johnson's attempts to try and force through a no-deal Brexit at the end of October. So ironically, that started to push up the value of the pound because people felt that the likelihood of a no-deal Brexit was reduced. But on top of that, the Bank of England, and in particular Mark Carney, started to suggest that maybe a no-deal Brexit might not be as bad as we first feared. And on top of that, we had some good economic numbers for the UK for a previous period of time. So that all added to a slightly more positive feeling around the UK. So that's why the pound rallied slightly. What that would have meant is anything, for example, that had exposure to overseas earnings. So if you had any global funds as well, they would have actually fallen in value despite those markets that they invest in were actually doing. But we also had some very violent moves in bond markets, some interesting moves in global bonds that were totally unexpected, to be honest. Now, if you look at the 10-year US Treasury yield as a bit of a benchmark, a week ago we were down towards 1.43 level. Then that has now since leapt up to 1.73. That might not sound a lot, but it is in the world of US Treasury. So that was a seismic move. It was a complete change in trend. We'd gone from going down with yields falling downwards and bond prices pushing up. We started to get them do the opposite. They started tumbling. So all those safe assets in your portfolio would have started to be dragged downwards. Now, this started in America, and it eventually, as the week progressed, we started to see that bleed over into global bond markets around the world. So we started to see gilt yields starting to rise, meaning gilts therefore started to fall. So this bond almost panic that happened started to unsettle investors. So why did it happen? Because obviously bonds have been rallying for a number of reasons. One of them included the idea that we may have a global recession. Now, there are some ideas out there that perhaps the narrative had changed, where we were no longer thinking that a recession was the most likely outcome. Indeed, we did get some slightly more positive economic news, but overall, the economic data wasn't much better this week than it was previously. So what it does show is the power of a narrative. So investors believe in a particular storyline they apply to try and understand markets. As soon as that shifts, and it can shift in the completely opposite direction, then the market trend can very quickly change. Now, we did have some slightly positive news on the US-China trade war. It's just the usual idea that China may be prepared to sort of reach some form of agreement in the future. We've been here before. We had the same news headlines concerning Donald Trump. So it's nothing new, but we have had some real violent moves in bond markets. So the question is, will these moves in bond markets continue? Nobody seems to know. As I make this video, the sell-off in bond markets has slightly slowed down. So we will see whether they start to rally, whether yields start to tumble. But it is going to be one of the big stories in the next couple of days, particularly when central banks are starting to have their meetings, which I'll come on to a little bit later. And if you go back to 2018, the reason why this is particularly interesting, we had a bond market sell-off combined with an equity market sell-off and a VIX spike, a volatility spike, which caused the really big sell-off we saw at the beginning of 2018, which we took ages to recover from. So are we going to see something like that? Who knows? Of course, if you look at equity markets, you'd be fooled into thinking that things are pretty good. So the S&P 500 eventually broke out of that trading range it's been stuck in for some time, started to push back towards the 3,000 level. And in the UK, the FTSE also rallied. So equity markets have been fairly buoyant despite what's going on in bond markets. But 80/20 investor members will get a newsletter this week which will discuss about what's going on beneath the index level of equity markets, which could be slightly concerning. There are some changes afoot that are very unusual, which could be omens for what might happen in the weeks or months ahead. So something to look out for, because if you just focus on the index level, everything looks just fab at the moment. Why are index levels and equity markets holding up? Partly that's because China has actually inputted some more stimulus. That's always positive. There's some hope that in the coming days the ECB are going to do the same thing. And of course, next week we have the US Federal Reserve's meeting, and they're going to make an interest rate decision, and everybody's hoping they're going to cut interest rates. So that is another possible positive that for equity markets going forward. So keep an eye on the ECB, keep an eye on the Fed and central banks more generally, but also keep an eye on equity markets, because we've had a slight pullback in the last few days, if we're going to maybe test breaking a bit lower, or where we will bounce to a new all-time high. So at the moment, a week seems to be a massive amount of time, not only in currency markets, in politics, in bond markets, but also equity markets. So it'll be interesting to see where we are this time next week. So that's it for this week on Damien's Midweek Markets. As ever, you can contact me at damien@moneytothemasses.com, via Twitter, money to the masses with the number 2, and of course via Instagram. And of course, make sure you subscribe to our YouTube channel.